Hello, ladies and gentlemen, and welcome to another edition of Economic Update. This is for the month of September 2023. Today is September 26th, 2023, and I want to say hi to everybody out there. Hope you've been safe and hope you've been over this heat wave that passed over us for the past, 6 weeks or so. We're here in Santa Fe, New Mexico, and it's cooled down a lot, and it's great to be back to where it's an enjoyable climate. Anyways, let's go on with our presentation, and we'll start off with our Treasury yield curve. Here on the screen you have the yield curve from June. I wanted to do a comparison just from a few months ago. This is when there was a Fed meeting was in, and you could see that the interest rates in the front end were still way above the 500 basis point mark. You got your 518 in the 1 month, and your 1 year was 524. Coming down in the 2 year, you had your 470. Looking at 920, this was last weekend. You could see where we're high above. This is right the day of the Fed decision, I believe. And we're at 553 and 557, and you could see where we're pretty much trending almost flat from month one to 1 year. Hovering between 547 to the high of 557 at the 2 month. Look at your 10-year here is at 435. I believe the direction that's been going, I believe this is going to break the 550 mark here, maybe even by the end of the month. But you could see in the realm where we can invest in here in the state of New Mexico, and many municipalities are the same way, from the 1 to 5, unless you have a core or some kind of other permanent fund, you can go up to 10 years. In your 5-year realm, it's 452, and your one year is at 547. So if you're looking for something to anchor in as a bullet, you can go to your 452, which if you look at your 5-year in June, your 5-year was 399. So you're still getting a good base, quite a bit of basis points for your money. Again, these are your federal fund rates, and this is what the banks change the money at. So when they're exchanging overnight, this is what it used to be the old Libor mark. Now it's the SOFR. What they exchange, the exchange rate is. These high rates are good for municipalities and investors for investing it in, and some people that they want to put their money into big nest eggs. But it could also be a challenge for at-risk people or people with medium income, and I'll go over that later. So we'll go on to our inflation, which has been the hot topic for the last 2 years. So you're looking here at June. You had the headline at 4%. Stickier or actual core inflation was 4.4. July was 3.0, and then the actual is 3.8. It drops significantly in that time. And if you remember, they were saying, well, it's finally over. Inflation is going down. A lot of investors were saying, yeah, they're going to start cutting back the interest rates, here towards the end of the year. Well, this slide here is August 15th, 2023, and this one on the right is September 15th, which they're identical. If you look at them, they're identical. And the reason why his data didn't really change that much, but however, it did start to creep up. The inflation that being that. So you got 3.7 headline, 3.3 sticky both months. So if you look at the annual rate of inflation, you can see where it crept up here in 913. It's at around 367. It's about 377 the last time I looked at it right now. So it's crept back up, and you could see in June when it went down to its lowest point, it's starting to creep up slowly but surely. Why is that? Well, there's different factors that have been contributing towards the sudden spike, and I'm sure some of you have seen. Just looking at the what's happened is the gas pumps for 920 that's day affecting our pocketbooks. And as everybody knows, FedPal, they kept the rates the same. They wanted to get some more data and see what happens in the next couple of months, because the next Fed meeting is in November. I believe they're going to do another rate cut in November, because there's still a lot of inflation. These Fed funds are for the year end, what they're going to end at. So you could see in 2023, their majority of the Fed governors are saying that we are going to be around the 570 realm. In 2024, by the end of 2024, we'll be at the about 510, 515. And in 2025, look at how it drops all the way down to 375. I actually think it's going to be around this area here at the futures rate, which is going to be around 450. Fed Powell has said several times that he doesn't expect for inflation to come back totally to the 2% realm until about 2025. And like I've said, there's a lot of variables and factors that are affecting the inflation to still loom. One of them right now is energy. The second, of course, is housing still. And then medical has made a comeback again, medical inflation. So those areas are still seeing inflation. Looking at the CPI, or the Consumer Price Index, you're looking at still high, areas. Energy was a lot lower last month and month before, and it's creeping back up slowly to the zero or back into the high inflationary rate. And if you see here from the right, you can see that your energy, commodities, and services have been creeping up again also. Looking at the electricity, it's pretty much staying almost flat, but natural gas and fuel, of course gasoline, has gone back up. Again, it's still, and it's not negative here. It's just saying that it was when it first was high inflationary. This is how much percentage has gone down. But let's look at the fuel and the gas. Well, this is the Brent oil market. This is from September 20th. It's $94 a barrel. It's looming over there, and you could see since September 13th through current, it's been looming over well over the $90 mark, and I expect this to go up after the end of the month to $100 a barrel. I'm assuming so. That's pretty soon. Looking at other items, you look at your food at home, food away from home. Food at home has been coming down. Food away from home is still high. This is like restaurants. So here in this realm, you have the price wage spiral, which means that restaurants are having to pay their staff more to keep them. And so they're also to match. They're having to raise the food prices. So this has been pretty high lately, especially if you go to restaurants. Food at home. Let's look here. You got your cereals and bakery products still high. Meat, poultry are down. Dairy-related products are down. Fruit and vegetables are still. They have come down, but they're still kind of high. And then your non-alcoholic beverages and other take-home foods. Going back to the dairy, a lot of things have gone down, and of course, pretty much everybody's seen that the egg prices have gone down, which was very high at the beginning of the year. But on dairy, my God, if you go and buy some butter, you're paying $6-7 for a little pound box. That's still high. Maybe that's why it's yellow, because it's gold, but it's super expensive recently. And if you look at your milk prices have gone down. So I've been making my own butter. It just makes better sense to do that, because I use a lot of it to cook. But it still looms very high. And looking at other items, you look at your commodities less than food and your services less than energy. So you look at that, you go and dive in deeper into that. You got your shelter and your transportation. Shelter's still remaining pretty high, and I'll go over that in the housing sector, but it's going to remain high for a while. And I'll go over that in that section. But your medical care and your services have gone up. That's been crazy over the last couple of months. And you got your commodities, less food and energy. So you got your apparel, your new vehicles and your used vehicles. Your medical care commodities have gone up. Alcoholic beverages and your tobacco. The sin index is what I call these for the part of your CPI have still remained pretty high. And I read recently in some economic bulletin that some municipality put in another additional tax on alcoholic beverages, and it wasn't in New Mexico, it was in some other state. Maybe somebody will remember that. But you look at your autos, your new cars and your used cars, they have gone down. The thing that concerns me is the interest rates. I call a lot of the people at risk, and what I mean by at risk, it's that they are low income to medium income, and all of a sudden they need a vehicle because their car conked out or something, and now they're paying extremely high interest rates on that. So yes, they've gone down, but on the flip side, the interest rates have gone up. So not really a win-win situation for people that are at risk, or they're just barely making ends meet. So that's very concerning in my opinion. A lot of people and a lot of jobs have done COLAs, cost of living increases, but still, if they're not really matching what's inflationary, people are still not making ends meet, even though that they've been gracious enough to give raises. So that's something. Some sectors that I always I take at heart, because a lot of people need transportation to work, and then on the flip side, they're having to pay more money on interest rates. So it's going to be that way for a while. I think the interest rates are going to loom that way for sure into next year, 2024, and 2025. So just hope that people's vehicles last and they can still. That way they don't have to participate in those high interest rates. Looking at the economist estimates for the Fed forecast. So let's look at the Fed funds. You got 2023 ending at 5.6. You got next year at 4.6. Then all of a sudden it just drives down a whole bunch in 2025. I disagree with this. I think it's going to be still in the 4%. I could be wrong, but there's just a lot of variables that are keeping inflation high, and I think the Fed fund rates are going to stay high. Your gross domestic product shrinks back next year. I think a lot of this is going to be the expansion. We're not going to have that expansion anymore. We're going to have contraction, because we have things just like something as simple as the students having to pay their student loans back again. That's going to cause a dent in their pocketbooks, and it causes people not to spend. Now they're going to have to save money to make payments on their schooling, and some newly graduated students are going to have to pay for the first time, so they're going to have to adjust their pocketbooks accordingly. The unemployment rate, they're planning it to go higher. I think that's correct. I think there. A lot of the things that I talk about every month, and a lot of people ask the same question. Oh, well, how can you say that we're in this kind of environment when there's a lot of jobs? Yes, there are a lot of jobs. You go to any place, at least here in Santa Fe, and someplace. I was in Nevada just a couple of weeks ago. There's openings all over the place, but there's no people. The participation is still not there. So they're going to have to adjust these numbers, because they always wanted, employment rate at 2%, 3% max, and I don't see that happening. Not coming out of COVID, and I said several times, once we come out of COVID, the economic outlook is going to be way different than what we were in beforehand. And I'll go over that more later. And your personal consumption is also reducing, and the core consumption also reduces. So that's our forecast. I have to agree with the consumption area. Looking at the rate hike probability, of course, this is after the Fed funds. This was the day before. Everybody knew that they pretty much were just going to hold the Fed rates right now. Again, do another pause. You could see that going into November, the probabilities of close to 30%. As I stated before, as the date gets closer to November 1st or November 2nd, I forget the date right offhand, these numbers will probably go higher. And like I said, I'm assuming that there's going to be one more increase for 2023. And you could see here at the time this was taken, the futures, only 8% was the probability, while other sections in Europe are still looking at rate increases. Moving on to the all Lehman Brothers index with the aggregated bond market, which is a snapshot of all the bonds in one, and to see where they're at. You can see that the yield to worst is now at 5.16, and which is high. If you remember about a year and a half ago, you were looking at spot 82 to the highest at 1.2. It's changed because this has been the safe haven now that the interest rates have gone up. The stock market has been volatile. The Bitcoin market's been volatile. The equity markets have been volatile. But yet, when the Fed funds keep on raising, the bond market has been getting really strong. So people have been going out of the more volatile markets and parking themselves in more safer bond markets. And it's just a safer place for investors to be. Of course, this is an index that we use as government investors because we're investing in treasuries, fixed income assets. So this is what we're seeing it at. But as personal investors, and I myself have been investing in the bond market because you're getting, it's not volatile. It's getting good interest rates for the next 2 years. At least if you buy in a bond for 2 years or 3 years, you're going to get at least high 4% to 5% return, which is really good in this environment. So might as well invest in something where you're going to get it. There's the volatility is not there. Other areas that they've been investing in is in the gold market or the metals market. Just not gold, but in the metals, because it just stays strong, and it's not volatile. It creeps up slowly, but it's a safe instrument to be in. Okay, moving on to housing. Housing's been on everybody's mind, not only in our county but in the nation. And let's look real quick at the 30-year mortgage. The 30-year mortgage right now and it's been looming around the 7.60 area, 7.6% interest. Yes, this is prime, anywhere for some prime, like I mentioned earlier, at-risk people that don't have stellar credit, or they have maybe their credit's not up there, it's their 600s. Their subprime, it's going to be a lot higher. You're looking at 8%, some even 10%. So it's been hard for a lot of people, especially millennials, first-time buyers now that are just coming out, graduated and looking for a home. It's been very hard because the interest rates are so high for them. Of course, these interest rates are nothing compared to what my parents went through. My parents, I think their mortgages was like in the 12-13%. Well, that was kind of standard back in the 70s. But they're still high for this type of environment when this high of inflation. and this is where I say I'm worried about the people that are at risk, because um, they need a home, they need a house. Their pocketbook isn't going to be really shiny for to make ends meet. So they're going to sometimes they have to supplement themselves by getting another job. Another thing that's been happening in the housing market is, and that's caused it to dry up recently, is you have multi-generational living. Meaning that a lot of people are going back home to mom and dad, or many of them are going back home to mom and dad, and saving money till they can afford a home on their own. That has also been happening, I think, with the labor market, that they find their ways to supplement themselves, especially after the pandemic. I mean, you got people on TikTok and Instagram and all these other social media platforms that they sell one or two items, and they're banking on that. They're making money, and hopefully that they're putting that money aside for a home. But these high interest rates, it can be anything from maybe paying from $1,200 a month to now they have to pay $2,000 or $2,500. It's because of these high interest rates. So it's real concerning to me. I know it's real concerning to a lot of other elected officials, especially in Santa Fe, where you got the AMI. You got like 5 or 6 different AMIs in just the city of Santa Fe itself. So affordable housing is not something that's really shining here in Santa Fe across the nation. So let's look at some of the stats here. You see the decline after May surge, where it's declining in the single family units, in permits. Multifamily units were up, but they've gone down recently. These are your the lowest 7-month in October for existing homes. These aren't for new homes, but the existing homes have dropped. People are just staying in their homes instead of trying to sell them and buy something in this high interest rate environment. It's just going to be a really rocky road for people, especially for the low incomes or first time buyers, just to get a home. And this isn't just only in Santa Fe. This is nationwide. It's happening all over. So there's plans in place. I know our treasurer and myself have been looking at a way for to help at-risk people get homes. So that's something that we're looking at in our area. Well, let's look at banking now. Banking's been a real rocky area since the Silicon Valley Bank disaster and the other banks that followed suit right behind it in March and April. Recently, Moody's just downgraded several banks. The one that's in there now is U.S. Bank and U.S. Bank Corp, which is the mother company of U.S. Bank. They've downgraded 10 lenders. And the bank index, you can see here in March, first part of March, just after Silicon Valley happened, it just dropped, significantly the levels of the index, and the confidence hasn't come back. Look at the from March to July, pretty much was a medium here at about 80, 82, 83. Went up a little bit in July and then back down again in August. I knew this was going to happen, especially in the big bank realms, because they were overextending themselves with credit and overextending themselves in their investments to get the better rates for their customers, but it winded up getting them downgraded. So look at the downgrades: M&T Bank, Webster, Bank of Oklahoma, Fullerton, Pinnacle, Old National, Prosperity, Amarillo. The Spanish comes out, so I think it's Amarillo, Associated Bank Corp, Commerce have all been downgraded. A new section that Moody's gave is negative outlooks. They're not looking at downgrades, but they just don't have what the potential like some of the other banks. So you got Simmons, Fifth Third, a really big, not only a custodial, but a really big bank. FNB Corp, Citizens, Capital One, another big name, Huntington, PNC, another big one, Regions Financial, Cadence, Ali, Bank of OZK are all have negative outlooks. But the ones that are looking at a downgrade now in September, October are Cullen, Bank of New York Mellon, huge bank, U.S. Bank Corp, which U.S. Bank is right under, TrueSit, State Street, and Northern Trust, another big bank, and not only a big bank but also a custodial. This is going to be interesting because a lot of municipalities, a lot of cities, they want to go to these bigger banks because there's sometimes there might be something that's attracted to them, that can services that's like, oh, we can jump on this service or that. Well, sometimes when you're getting out of the sandbox and wanting to get onto the playground, you can get run over really quick by putting your money in the wrong area, and then now you're going to have to ask for more collateral because now you want to make sure that your money is going to be secure. Here's a Moody's from August 7th, stating that now they're looking at U.S. Bank Corp. They're going to look at it all now in September. Again, there's a lot of strains in the bank sector, which happened after the Silicon Valley disaster, and it's just going to they're going to look at it. But this is going to be, those banks are probably going to be in the downgraded side. State of New Mexico has some money in the U.S. bank. They're probably going to be asking for a lot more collateral than usual. They were at 50%, and then they raised them up to 100 because they were under collateralized at one point. So they gave them a slap on the wrist. Now I'm pretty sure they're going to be more over at 102 area, or maybe even 110. Just something to look at, especially if you're in those big banks. Sometimes it's better to stay in a smaller bank where you know that they're not going to be overexposed, and you're going to be pretty much the cream in their cream pie, like I like to say, because they'll pay attention to you more than these bigger banks. So that's just an opinion I have. But looking at that market again on the 25th, this was yesterday. I ran this before I did the slide deck. Still down. You're looking at 80. It ended yesterday, actually 78.52. So it's always just, I think a lot more banks are going to start to also show some risk now that the interest rates are so high. I know Japan is having a problem because they've invested highly into our treasury bonds, and now when they were buying them during the pandemic, they weren't getting that much. Now their treasuries are underwater, so it's just been a big disaster all over. That's why I'm saying I think we're going to be in these inflationary times for a long time to come. So let's look at some of these inflation takeaways that I've been blabbing about for the past 28 minutes. You have the CPI has slowed down and shot back up in July, and it's still looming again. Not super high, but it's creeping back up. Student loan payments can cool the growth big time because there's something like $3 trillion out in student loans. Food prices still remain high, especially in the take-home. Jobs are up, but participation is down. I've been saying this for months. Energy, housing, and fuel has increased, and there was one report saying that it's going to be another expensive winter. Hopefully, that's not true. This was something that I didn't talk about, but I want to talk about it briefly. The return of the supply chain shortage. Yes, it's back. Supply chain shortage is back. Why? Because we've been buying a lot, and we unfortunately rely on a lot of other countries for our products. So, and they're having problems over there, and so we're not getting as many of the items that the purchasing managers are ordering. They're not seeing them come in, or they're not seeing them come in fast enough. So that has returned. So that's another variable to put into that inflationary time. So again, looking at the cooling of the existing house market, building in new homes and have slowed down substantially, and credit card balance are still up. And sometimes now they're going to look at banks, and that's another thing that banks are doing. They're not lending as much as they're doing anymore. So a lot of people with card balances are looking at credit unions and all that to pay off those balances and still have a higher than normal interest rate, but not as high as the credit cards are. So they're looking at getting maybe a bank loan at 6-7% rather than having a 29% credit card interest rate there. So people are having to do different things to bring down their debt, and sometimes it's easier just to get a loan from a credit union. Something I wanted to bring up, and I brought it to light a year and a half ago, and again maybe about a year ago. Stagflation. We have all the things that are all the, I can say all the ingredients to being a stagflation environment. I know a lot of you people are saying, "Well, that's crazy." The last time we were in stagflation was in the 1970s, and the only time that we were in stagflation. Well, we yes, we have a lot of jobs, like I've been saying, but we don't have the employment. We're not having that much growth. The inflation is still high. This could be something that could kick in real soon once the numbers come in, and don't want to cause us panic or anything. This is just saying this is something to look for. That you could look into, have a strategic plan for it, just in case your municipality winds up in this environment. If we're in this environment, then you have backup plans. It's always good to have some capital in the bank, just in case this would arise. But I just wanted to put that out there because it could happen. Like I said, it hasn't happened again since the 70s. So it was mentioned a couple of years ago, and I mentioned it, and I'm still seeing that could loom over us. So let's go to this baby throwing out the money, investing in this environment. Again, we looked at the dot plot in June. This is what it was. You got some of the Fed governors at that time saying that, we're going to be above 6%. The medium was going to be about 570. And then by the end of 24 at 450. And then you have Fed Powell saying that core inflation won't hit 2% before 2025. I still believe that to be true. Let's look at Fed Day. The governors are still saying, we're going to stay at that level, but now this has moved up in 2024 up to over 5%. And like I stated earlier, I think in 25 we're going to be more in the 450 area rather than the 390 area. And 26 and 26 to 70, who can see the future? But looking at the front end of the yield curve, I'm thinking these numbers are pretty much factual, except for the 2025. So looking at that and looking at how to invest, we look at what's been going on with the Fed rates, and we've been trying to invest in those times in short-term treasuries or in CDs where they mature within those dates of the Fed funds. That way we can capture a higher coupon. But what we've been doing is at those, as it's coming down here, we've been trying to anchor in bullets for 5 years at these higher rates. That way, if the Fed funds do go down into the threes, at least you have either 5% or high fours for 5 years. That's the best way to approach that. But again, that's not. You always want to have a good mix. So you want to have front end, and then you want to have a balance there after 5 years. So the strategy for that is your short-term treasuries. Again, your 1 month to 1 year discount Freddie K's. I found a lot of these to be really worth investing in. The 003s, 005s, 007s are the best ones to get them at a discount. Those are the best ones to do those. This is another type of MBS that I found some light in. Commercial paper, 180 day max. Again, investing in them in 30-day, 60, 90-day cycles to reach the Fed funds forecasts as they increase. Broker CDs, 6 month to 5 years non-callable. However, recently I've been seeing a lot of 5 years that are not non-callable anymore. They're actually they either have a step or they have a call function. So that's telling me that the banking market is thinking that within the 5 years that the Fed funds are going to go down. So I'm assuming that's why. And if you do find a bullet, it's usually at a premium. Just FYI on that. 1 year to 3 year fixed income with or without call options. And finally, your 3 to 5 year bullets to anchor those high interest rates. Again, that's just how we do it in Santa Fe County. It's good to share. I like to share this with a lot of people. Knowledge is always the best element for investing, and not only investing, but to get a good economic outlook, a good sound economic outlook. Again, these have just been my thoughts, ideas. I wish to hear from you soon, and I'll be posting another one next month. Until then, have a great month.